Hmm. All right. Well, once again, good morning, everyone. Um, Today's series, as we continue on understanding how to build our own business plan and develop it so it can be a good tool to start and also to kind of check in as we start looking at wanting to grow our own businesses. Uh, Part of the session today, we're going to cover the financials. Last month, we covered budgets, and they're very similar to the financials because you kind of have the budgets in the same format as your financials, because your budget is supposed to give you a financial indicator of what it's going to take to run your business, produce your goods and services, and also what expenses you need to kind of be able to anticipate, and then if you're going to make money or not. Well, the litmus test to be able to measure those things are financial statements. And I want to be able to at least take the time, if you have questions, just let me know. You can let me know by kind of putting a hand up in your box, or just clicking on, because I really want people to understand this, because sometimes when we start as business entrepreneurs, we get to the point that we want to make money, but we don't understand that the numbers will be able to show us, how much we're making or how less we're making or what we need to do to invest. And sometimes numbers kind of get people frustrated. And I want to just go over some 3 basic financial statements that will give us an idea of how we're doing. And each of these statements show us that in different ways. So we want to get rid of some of the mystique and try to be able to understand that it doesn't have to be difficult to be able to understand where we're at and where we want to go by looking at financials. So we're going to go over some samples, and then I might put out in the chat an example of a financial statement from a public financial statement of a large, very large nonprofit, if we have time to go over that. Once again, for those who are in the network group, Loving Myself First Business, you have access to this Kingdom Economic books I wrote a while ago. It gives some principles on finances and also understanding yourself. There are many business entities, and a couple of the sessions, I think this first or second session that we've done this year, I went over different business entities. So you can look that up in the Loving Myself media video section, or go to YouTube and I upload the video of these sessions after we do them, and they're available out there too if you want to go over those. But it helps some to be able to understand what business that you want to operate, as far as, is it sole proprietor, is it a partnership, is it an LLC, nonprofit? All those things have different ways that you go about to prepare to develop your own business. And then the business plan is just a document that helps map out, how you're planning to start up or operate or expand. And it takes in all the different functions and segments that you need to be able to take the time out to kind of look at, so that you don't get caught unawares. One of the things I keep saying over and over again, it comes back to people who build, those people that build houses or carpenters or whatnot. They will always tell you, you want to measure twice and cut once. And what that means is take the time out to really understand and examine your risks, so you're not caught unaware. One of the things that, if you've attended these sessions, you hear me talk about a lot, is when you're really ready to start your business, keep in mind the journey typically is about a 5-year window, that you take, because you have to, gain access to resources, capital to start. Then as you start, you can only do maybe so much with the resources. So you have to be able to know, what am I going to do with this particular part? And then once you get to that, what do I need to get to the next level? How do I add additional resources? And what am I going to do with them? So it allows you to prioritize things so that you understand that most businesses fail within the first 3 years. So you have to know that you're going to have to understand a cliff going in beyond that 3 years if you're going to really see the successful and the benefits of that. So understanding that, that keeps you in pace with being able to surround yourself with others that can encourage you, which is why I like this network of individuals who are trying to do things for themselves and start the business, because you can look at it and be frustrated at times saying, I thought I was going to be here by now, or I think I needed this, or I got this. And it can, and knowing that you're not by yourself is important. So that's why I put a lot of the information. I say, go back to some of the sessions to go over some of the things to help. Because I remember my time, I've been wanting to start business, and I had it in such a, in different ways over the last couple of years, but it took 20 years or so into the making for me to be able to really launch out. And I remember when I finally launched out, I'm sitting up, I gathered all my resources because I work remotely most of the time. And I'm sitting in my office, I had my computers, things sitting there, and I had no clients. I'm just sitting there. And I'm like, wow. But then all of a sudden, all that work I did over 20 years of networking, doing seminars, running other companies, people started reaching out. And then I spent the first 6 months, when it didn't seem like I had clients to do, getting myself ready to be able to respond. And then when I got the clients, then start getting those things, I started learning and organizing that, wow, just because the contract's available doesn't mean it might be the right fit for you. And you don't want to make the same mistakes I did. There was times I took a contract that I didn't have the resources to be able to deal with that because I had other things I was going. So, that contract got canceled. And I said to myself, I'm not going to do that again, because I don't want the reputation of what I do be diminished by the fact that I exert myself into things that I can't be able to do. So, but I use that as a learning opportunity and said, okay, I'm getting the requests and people want to give me the contracts. So I need capacity. So I need to be able to say, what can I do to be able to meet that? So I, for one couple contracts, I set up, I set up contractors. So I engaged a couple people I had learned in the past. So, this goes back to purpose. There's reasons why you go and do the things you do, so the people I had contact in the past, I was able to say, hey, can you do this analysis for me while I'm working on this? So I was able to engage them in a contract and continue to still do some of my other contracts and still fulfill that. And what that let me know is that I can get the contracts, but I can't fill all those contracts by myself. So my next stage in my plan is about human resources. It's about, can I get can I get a person, whether it be part-time or on a contractual basis, that I can commit so that I can take on contracts and with my enough rate, cover what that person wants, at the same time be able to cover a little bit more profit for myself. So those are the things. Now I started reaching out to network of folks to say, okay, do you want us another side hustle, or do you want to get engaged as a contractor, for some projects? And so I'm trying to build that up so that for next year I can then increase my revenue margin without having to increase my own ability to try to fulfill those contracts. So that means I'm going to have to give up some of that revenue in order to be able to someone else as a contractor or maybe a part-time employee, in order to be able to generate more revenue that I wouldn't been able to do myself. And so once again, that's why I say these business plans is an ongoing thing. You just don't stop. You always want to say, how do I continue to expand? And so I want to encourage you all as you continue to do that. This is a journey as you continue through, and you'll learn as you go through. But the better that you take these sessions that we've done over this year into heart and really look at it and plan, then you'll be prepared to kind of move on the dime. I said always that one of the things that I learned as a CEO is that you had to have a plan A, B, and C. So when you go through and you're starting a project or doing something, you want to have your primary thing that you really want to go for. But at the same time, if that doesn't work out, or you have to deter from that, then you want to make sure you can go to B or C very quickly. Else you're going to be going right back to starting and planning again to be able to deal with the situation that you could have maybe taken that time up front so you can be able to react and save some time to be able to do it on the spot. So, you know, as an entrepreneur, you got multiple hats you got to do and deal with. So that's why going through this business plan, we took the steps each month to go through it, just so that you can at least look at other examples, you know, and then be able to say, how can I apply that to my own business? Now, here's the elements of the business plans that we go over. You know, you have your executive summary, which is the last thing you typically will do, because it summarizes everything else that's detailed within the rest of your plan. And the executive summary is kind of like, for those who want for employment, your resume. You know, basically, you know, when you do a cover letter, you sit there and say, okay, this is what I do, this is what I can do. You want to show that you can meet the needs of what the employer is trying to ask for you. Well, the executive summary is to that point where it says, okay, when you go through if you want to go through the rest of this plan, I'm going to tell you, this is how I'm meeting the need for whatever I want. If I want investment from you, if I want opportunity, networking group, this is the capsulation of all the things that I'm doing with my business, so that it's in a summary format. And then if you want more detail, you can go into the detail. So that's why usually the executive summary is the last thing you do. Then we went through all the other different things. Company services. What do? You know, who are you? Your mission, vision, you know, your values. And then what are your products and services? How are you going to get that out to the market so that you can be able to make money? Strategy and implementation is, what is your strategic plan, your operational plan, in order to be able to run your business? And then management summary, we haven't really gotten to that too much, but that is, who are the individuals that are going to make this happen? You being the primary entrepreneur, you get your profile yourself, your experiences, what do you bring to the table to make this happen? And then if you have other folks that are going to be employees or contractors with you, then you want to spell that out, because, you know, I need to, if you want me to invest in you or be able to buy your products or services, I need to know, you know, how you're going to get it done and who's going to be with you. And then the last piece, you know, which we started last month, was the budget. And then we're working today with the financial statement, is your financial plan. You know, this is crucial, because most people, if you really look at it, and when they ask me to come in and maybe look at assessments about, you know, or do a budget or do assessment of a business, you could really tell upfront before it got to the point whether or not it was going to make money or not. And usually people get in because of energy, passion. I'm going to get in and do this. But if you take the time to lay it out, it will tell you, okay, it's going to take me, you know, 18 months to start making money, or 24 months to start making money. And that's not to say don't do it, but then you have to be able to react and say, okay, what do I need to do then in that time before I make money? Do I need to, you know, develop resources, cash, borrow, you know, go out and get some other partners? That will let you know what you have to plan for it, because of what you see coming down the road. And unfortunately, a lot of people jump into things, you know, for energy, and then they say, oh, wow, I don't have the money that I thought I was. Well, if we would have planned out saying, here's the product and services you're going to offer, here's the amount of people I need to do to be able to generate this money and services, then you would have an idea of what you should be targeting and marketing. So saying, for me to hit that target, then I need to be able to get out in the market and gather 10 people in order to draw this amount of money in dollars. Oh yes, Roberta, go ahead.
And I'm being who I am, because that's all I know how to do. Pray about who you partner with.
Yes.
I'm gonna say that again. Pray about who you partner with, research some people, find out their background, their sustainability, get their financial background, because you can make an investment, or you can tie yourself to someone. It's just like they, you know, we talk about in church about soul ties. You can get tied up with somebody, honey, who wants to take you directly to hell in the mental, physical, spiritual, financial, and business worlds. And we forget sometimes that, and I'm not, you know, trying to sway anybody in regards to Christianity or not Christianity. I believe in Christ. Who you believe in is your choice, because we have a large audience across the internet. But the reality of it is that everything you do has to have a positive intention. So if you think positive, you want to be tied to positive people. If if you're a hustler and you're a grinder and you have linked or tied yourself to someone who doesn't have the same hustle and or grind, you'll end up doing all the work and they'll end up collecting all the rewards. So please, please, please consider who you are partnering with. Walmart is a wonderful company, but can you handle the expectations that they have of you?
You make an excellent point, because when I do executive coaching, because executive coaching is one in the line of my businesses, I really enjoy that, helping people develop and get their goals and see their purpose. But you're right. Just because people can do things doesn't mean, just because people can do things doesn't mean that, and they're skilled at it, doesn't mean it's a good fit. And one of the things I do when I'm looking at it, when I'm coaching, and is, when you're trying to develop a business or a department or something, you have to make sure you understand the level of the person. And that's why I always say, even though this is business sessions, the first year before I got into business sessions, I dealt with us as people, because you have to really know yourself, your emotional intelligence, to be able to look at others, examine, because a lot of things that happen in the business and the breakup of businesses is very similar to like a marriage. And if two are not on the same page, even though they might be able to have the same skills and be able to do the things, it's going to be a mess that's going to end up in divorce. And that's just the reality, even with business. That's also with employees and all that in a workforce. And as we start growing, you need to make sure those things take place, because it can be very ugly, and you could be very distractful, dealing with these things when it's going to be already tough enough trying to grow your business.
And even I've joined organizations that have somewhat of a similar desire to serve, community organizations, but they're stuck where they started. And I think if anything, I'm watching they give a financial report every month, but they have no one who's actually getting paid. All they use the money for is to pay for food. And the other piece to it is that if you're still at ground zero and I'm trying to progress, like you say, the organization deals with health disparities, which is what my business is connected to, but they're stuck in one issue in health disparities. And they did this research 3 years ago, and they're still on that train of what happened 3 years ago. I'm like, when are we going to the next location, y'all?
Right.
So that's what you need to be mindful of. Not saying that I want to get out of it, because I'm building a network of other relationships. So you may want to stay there because you can find other people to partner with who come in and visit and exit, guest speakers and things like that. But don't stay stuck with someone who's not going in the direction you're headed.
Right. Great advice. And, I see it all the time. It's just so, and keep in mind too, and this is the other thing that I learned as an entrepreneur versus when I was running companies or being an employee. When you're an entrepreneur and you develop your business, and this is something you have to take to heart, no one's going to have the same passion that you have for it. And I think we make a mistake that, okay, we're busting our butt, we're trying to get into this thing, they need to be working just as hard as I am. That is a fallacy, because you started because it's you own that. And so you keep that in mind when you start getting to the point where you're looking at contractors and employees and things like that. This is yours, and no one's going to run it like you, and no one's going to see it like you. So keep that in mind, because we can kind of be very, come down hard on folks, or be very judgmental on that. But remember, it's a business, and to some people, it's a contract, it's a project, it's a job, but to you, it's your life. And so you have to view it that way. And that's why I said emotional intelligence, from the understanding, loving myself, personal development is important, because you got to be able to step into that person, not see it from just your perspective. Let's look at these financial statements here, and we're going to go over and just to make sure it's kind of break these down. Now, as you get, as you get much more skilled in it, you'll be able to know, such as experts like accountants, analysts, they can look at numbers and kind of really get an idea of what's happening, how trends are, what's going on, what are some shifts you need to make, where you should invest. But we want to just get a basic understanding of our business so that you are aware of it, so that you know some things about it, so that you don't get necessarily taken advantage of. In the financial plan, there's a whole bunch of things in the business plan that you need to do that's part of their financial plan. Important assumptions, break-even analysis, projected profit and loss, your projected cash flow, projected balance sheet, and business ratios. Between the budgeting and doing the financial statements, these are things that we cover in the development of the financial plan. One of the requirements of a financial plan is, once again, budget or projections, which we did last month and talked about. And today we're just going to talk about a little bit more about the financial statement parts of that. Here is an example of a balance sheet. Now let's go over and understand what a balance sheet is. A balance sheet is basically what we formally call it, the accountants, the CPAs, it will say statement of position. What that says is where you are at as of a certain date. So it's what you have, what you possess, what you owe, and what you're worth as of a certain date. So the elements of a balance sheet is assets. Now, we always hear about assets. We need to grow assets, have better assets. Well, assets are what you own. So that's cash, investments, accounts receivable, what you bill out to people and you haven't received it yet, that is an asset. Think about it. If you buy things and it's receivables on stores or whatever, and you don't pay and becomes debt, well, they sell that receivable to debt collectors to get money. So the receivables is an asset. It's what you generated through your sales or services that you build out, but you haven't received. Inventory, things you have to purchase to be able to run your business, to produce your products and services, that's an asset. Buildings, equipment, and etc. So the things that you purchase that you own, that is assets. And you can see the assets on the left side of this balance sheet example. And they break it down between current, property, equipment, and other assets, but it encompasses the things we talked about: cash, accounts receivable, inventory, investments, building, equipment. These are typically your assets. Well, the other part of your balance sheet, the other part of the balance sheet is also going to be the liabilities. Now, the liabilities is what you owe. So they can be accounts payable. So when you order something and it comes in, you haven't paid it yet, that's an accounts payable. Loans, credit cards, those things are debts. Those things are liabilities of your business. And once again, the example that we have over here is we have accounts payable, notes payable, those things are typically long-term debt. Those are your liabilities. Now, the last part of a balance sheet is equity. And that is what is left after you have your assets, what you own, less what you owe to other people. What's left is your equity. And equity is named in different ways depending upon what type of business entity. In corporations, it's retained earnings. In nonprofit, it's fund balance or reserves. You ever heard the word, okay, what reserves? Personally, if you have a personal financial statement and balance sheet, it's your net worth. So when you go around and say, what's the net worth of people? That's basically what people have after they have their assets less their liabilities, what they owe. That's their net worth. So those terms you hear is referring to equity. And so this example is a corporation's balance sheet because it has shareholders equity, common stock and all that, and retained earnings. So this is the equity of a corporation of a balance sheet. But once again, like if it was a nonprofit, it would be net assets, fund balance. If it's a sole proprietor, it's going to be your retained earnings also. So when you look at a balance sheet and you take a snap, it's a snap of today. If I took a snap of today, what cash do I have? What's owed to me? Accounts receivable. What do I, what are cars, what equipment, what things that I have? Those are your total assets. Then I say, okay, what's debt? What's on a credit card based on what I did for my business, or what loans, business loans, car loans, lines of credit. Those are what I owe to other people, and invoices I received that I haven't paid yet. Those are your liabilities. So when you take that, your assets less your liabilities, and in this example, we have $472,000 of total assets. We have liabilities of $247,000. So the equity then that's left of our business is the difference between 472 and 247,000. So, approximately you're looking at about $230,000 of equity. And that's good. So you always want your equity to be positive. When your equity becomes negative, that's when you're losing money in your business. So if this equity amount is a negative, that's not good. That means your operations is running losses. And so you have more liabilities than assets. So the balance sheet is a quick way of a snapshot to see the financial performance of a business entity. Now you can get into a lot more ratios, like current ratios and things like that. That's what an analyst get when the financial statements, for instance, if you look at the current assets of $149,000 and you look at current liabilities of $47,000, this is a good ratio, good balance sheet, because typically you want your current assets to be able to cover your liabilities, a 1-to-1. This is more than almost 3 times the amount. So you have 3 times the current assets than liabilities, meaning that in the short term of operations, if you had to pay all your current liabilities off, you would have enough current assets to go ahead and pay that off if you stopped operations. So that's a positive thing to a bank or someone that wants to invest in you. They're saying that you're producing enough cash to cover your current needs. You can get into a whole bunch of other things like debt to equity ratios, where you look at how much of your total, your total debt, notes payable is a debt, long-term debt. So you got about $210,000 of debt, and you compare that to the $210,000 of equity. That gives you a ratio that, does your overall reserves have enough to cover this debt for the period of time? If it doesn't, then typically what happens to a financer, a bank, a mortgage, what they'll do is they'll say your interest rate will have to go higher because there's more risk, or you might not get it, or they might say you have to come up with more collateral or resources for us to be comfortable, because how your current operations is looking, you might not have enough cash to cover this loan if something happens to your operation, your business. So you can tell a whole lot from just a balance sheet. But the key thing for you and for your business is to make sure you can at least develop it so that you have an idea ongoing where you're at, from a day-to-day position. Now, I'll talk later about some resources that will help out with this, but anytime you have a business, you need to be able to understand and know what's the balance sheet that I have on my business. When you go for personal loans and things like that, they ask for personal financial statements. It's the same thing. You go in, what's all my cash accounts, my investments, what loans I have out. you do that for yourself, you'll be able to see if you have a negative net worth or a positive, you know. And these are things we can do for ourselves so that we can keep and understand. And knowing that, you know, when you're applying for credit cards or loans, they're gathering this information. They ask, what's your cash accounts, what debts, what's your mortgage? They're compiling a personal, you know, financial state, I mean, you know, balance sheet for you, so they can analyze it to determine what should you get the loan or what rate. If it's a higher risk, you're going to get a higher interest rate on the loan. If you're in a better risk, better position, you're going to get a lower interest rate. This is why, you know, if you ever heard that when you're good, when your business isn't good, you got good cash and everything else, that's the time to set up loans and lines of credit when you don't need the money. Because when you need the money, that's the banks will see that, and your rate's going to go higher. So when you're in a good position, that's a good time to establish a line of credit. You know, you can sometimes, if you do, you know, you can get a line of credit if you're in a good position, and if it depends upon which institution, they might just charge you a fee just to have it if you don't draw anything down on it. So that's negotiable. Some, you know, but it's good to have that when you need it, because when you have cycles of your business up and down, keep in mind, remember when we say over a 5-year period of time, it's going to take to build up there. You're going to have some good time when, you know, good business is good. Then you're going to have some times when business is down, but you have to be able to live through that. So that's why knowing and projecting how much you're going to need over that period of time, you can finance it different ways, through a business loan, which is something you pay each month, or a line of credit, which is gives you a cap of what you can borrow when you need it. Another, you know, construction companies use lines of credits all the time, you know, because suppose they want to do $1 million project, and over that project, they get paid based off a percentage of completion. That's a common way in contracting, meaning that if it, you know, if this project's $1 million and I'm 20% completed, then that's $200,000 of money that I can draw down on for that revenue. Well, you have to pay out to your workers, you got to pay out for equipment, all those things. So it might cost you $400,000, you know, up front. Well, if you're only going to get $200,000 for that $1 million job, you need to borrow and have a line of credit for $200,000 so that you can pay people to keep working while you're waiting to finish this project. So those are key. I know a lot of times people say, you know, oh, we don't want to go into debt. There's a difference between getting a loan and going into debt. Getting a loan is to finance based off of the dollars that you know coming in, that you contracted for, and things like that. When you're in debt, that means that you're in a negative net worth. You got negative equity. That's in debt. That means you don't have enough coming in to cover your liabilities. That's debt. But getting a loan is not necessarily debt. Now you have to know yourself. If you get that money and you want to waste it or not invest it properly, and you still got to owe that, then you get to the point where you don't have enough cash to cover it, then you become into debt. So those are things where understanding your current financial situation will allow you to be able to be flexible. Another point of this too, why you want to emphasize on your assets and cash, there's a saying out there, cash is king. You know, you want to hold on to as much cash as you possibly can. And that's why, you know, lines of credits and business loans that are appropriate are good resources, so that you don't have to be going out, paying out all your cash, waiting for money to come in, because you can't live that way and your business can't live that way. So you want to make sure that you maintain healthy cash balances, minimize your liabilities so that you can increase your net worth. That is basically what this balance sheet kind of wants you to do, tells you what to do. Any questions before I go on to the next statement? Okay. All right. Next statement. Income statement. This is the key where we say, are you making money? It's profit loss. The old school term was profit or loss. You will hear me sometimes say P&L, because that means profit and loss. The income statement is shows you over a period of time, where the balance sheet is showing you of a certain date. The income statement is showing you over a period of time. It could be 1 month, it could be 3 months or a quarter, it could be 6 months, it could be a year. So you will always see on an income statement the period of time that this is showing your income and your expenses. In this example, it says year ended. This is a 12-month period because it's a year. So this is showing the activity over a year. Now, what activity is it showing you? Well, in the income statement, you have your revenue, which is your inflows of income from the sales of services or products. So when you make a sale, that's revenue. When you sell a product, that's revenue. Now, the other things that you have to account for in an income statement is a couple things. Cost of goods sold is that if you make a product, so this is not people who do services, but if you're a person that makes a product, you sell a book, I have a book out that I've sold. And I know Chanel, you have your book out that you published. Congratulations on that. Well, when you sell a book, you have the book price. Suppose the book price is $10 and you sell 10 of that. Well, that's $100 of revenue. Well, in order for you to make that book, you have to do printing, publishing costs, all these different other things to be able to generate it. Well, so if you have costs to generate a product, that's called cost of goods. That is the cost to be able to directly impact the generation of a product, or it could be a service depending upon, but mostly it's in products. Stores are notorious because when they're selling you, that clothing, they have to pay for it. And the cost that they have to pay for it and all advertising and all that, that's cost of goods. If you go into Starbucks and you buy that venti, caramel, whatever, I'm not a coffee drinker. I like my chai latte. Well, to produce that chai latte, they have to have milk or almond milk. They have to have the chai. They have to have, so all the things that they have to do, the purchase to be able to make that chai latte is a cost of goods. Then you have your other costs, which are your operating costs. That could be the building, the rent, salaries, benefits, off expense, utilities. Those are your operating costs. So when you take your total revenue less any cost of goods, if you're making a product, okay, then any other operating costs, then that gets you your net income. That's your profit, or it could be your loss. And this is why I say measure twice, cut once. If you project out what it's going to take to do what you need to do, using all the sessions that we have done up to this point, you're going to have a pretty good idea if you're making money or going to be losing money. And if it shows that you're going to be losing money, that doesn't mean stop. That means, why am I losing money? That's where these statements come in. It's not just you got to produce the information, but then what are these statements telling me? If you're losing money, why? Is it because revenue is not enough? Why isn't revenue enough? Is it not generating enough sales, or my product or services are priced too low? How do you know? How do you know if your product or price is too low? That goes back to the market analysis that we talked about. The market would dictate that. The example that I gave of myself at the beginning about my pricing, I know that I keep getting requests for different projects. So I got a demand. Now I'm having my certain contracts at certain pricing. Now, if I have too much of demand that I'm not able to satisfy myself, I could do two things. One, increase my pricing, my rate, to see if those demands stay steady. If it does, that means my pricing was too low to begin with, because people are still wanting to be able to utilize me at the price that I have adjusted up to. The other thing too that I can look at also is that if I'm at capacity, since I am the product and I still have a demand, I can increase my rate, but then increase some of my expenses by having an employee or a contractor to do some of that excess capacity. And then if I have my pricing to the point that I can get a margin out of it, I'm still good. That is what I'm working on for my next year goal, is to say, okay, if I increase my rates up a little bit more and still maintain that demand, I can take a portion of that increase and pay someone else to do that particular project, and then still make margin off of that I can come to my business, even though I'm not working it myself. And so you look at all these things. So all these elements that we're working through are not just to be able just as a project, but these are things that are necessary in development as a foundation for business. So you can see that in order to do revenue, you have to understand pricing, which we talked about under services, the services or products we're going to offer. We talked about marketing. How do we get our product or services to the market? And the market will demand what the pricing is. And then we also talk about budgeting. How do we go about making sure that we have good pricing? Some other things is, if we're losing money, it could be, we could make what can we do about our expenses to lower our expenses down? Can we look at getting in bulk versus one-offs? And if we do it in bulk, knowing that, suppose we're going to look at for the year that we might need enough material for a whole year, that might, that if we do it on a monthly basis, it might cost us, let's say, $30 a month to purchase the material necessary. And we do that on a monthly basis. So that if we do that for 12 months, that's $360. Well, typically wholesalers will go, and you can make agreements and all to say, instead of paying that $360, which is $30 a month, I will pay you $275. I want that upfront now. I'll pay you $275 upfront for that material. Now you just saved, 60 plus the 25, you say $85 for that particular thing. And if you do enough of products and services, that $85 could spread out to be $800 over, to your bottom line. So, and you will see that too. If you notice, like, for instance, when you're dealing with personal things like Apple, for instance, Apple will say, hey, you can go ahead and subscribe at this amount per month. But if you want to go ahead and just pay us up front, we'll give you a 15% discount. So those are things that's why planning out. And that's why also maybe being able to have a little bit of line of credit or research, excess cash, reserves, that it might make better sense to buy things up front than try to buy it as you go along, because overall it's going to save you money and lower your expense ratio, which will increase your profits. So those are different things you can kind of look at and negotiate with expenses. The other thing too, and yes, Roberta.
So with our income statement, okay, so for those of us who are just starting out, and I'm just throwing out scenarios right now. So our income statement, we should, for the first 3 to 5 years, because we're talking 3 to 5 years, we should keep the income statements even for the little things. Like, I'll give an example of people who bake goods. Mm-hmm. So when we're looking at an income statement, we want to look at we want to keep those for 3 to 5 years so that investors, lenders, etc., can look at the trends of what we buy and what we sell at that time in order to approve or deny loans or consider an investment, or when a good time to make an investment to get a return is, or something like that. Am I correct?
Right. Remember when we talk about budget for 3 to 5 years, if you're already operating in it, you want to put your actuals up to that point, and then you have to project out to the remaining period of that time. And that's good, so that we can know, as you're dealing with partners, there's other ways that you can be able to meet those needs, and you're correct on that. And plus, you also want to be tracking what your actual expenses and your costs are, because even if you're building your business, you also can be able to use it for tax deductions too. So, you might have a loss, but that loss can be deductible in the tax basis. Now, keep in mind, you don't want to have an operating loss for 5 years straight, because they're going to deem it as a hobby from a tax perspective. But are there losses? There are times when you might have surpluses, profits, but then times a loss. And typically based off the structure of your business, you might, if it's a corporation or a LLC set up as a corporation, you can have net loss carry forwards, meaning that if you have a great year this year and you made $100,000, but you had a $30,000 loss last year, you can bring that loss forward to reduce your taxable basis from 100,000 down to 70,000. So there's a tax basis you can look at this too.
Okay, so I'm hearing something that may help some of us who, are new to this and not true to this. So for all the personal money that I've put in, I can use that as a tax write-off on one hand, because I'm making an investment. Go ahead.
Well, when you now see that you just said it, for the money that you put into your business, you've made an investment. Okay. So that would be, if it's a sole proprietor, that's going to go into like your retained earnings as a capital investment. It's not going to go in as an expense. But here's how you get that deduction. Suppose I put $20,000 into my business. So the way that it would show up on my income on my balance sheet. And let me go back to the balance sheet here. So if I put $20,000 into my business would show $20,000 cash, and then over here on the equity part, it would see this additional paid capital. Mm-hmm. That's a corporation, but it's the same thing for if you're a sole proprietor or whatever. It would be, reserves paid in or contributed type earnings. So it'd be contributing to your net worth of your business. Okay. But then the way that you would get the expense deduction is then when you spend this cash in your business account for expenses, then it would show up as expenses.
But as a nonprofit,
then you have to then, instead of making an investment into your business, you got to make it as a contribution, as a donation. If you're set up as a 501c3, you can make a donation to your nonprofit, and that donation as a personal deduction on your personal return.
Got you.
Yeah.
So I'm gonna come back. So as a nonprofit, I'm making a donation. Mm-hmm. I'm saving all those receipts on one hand. I'm saving I have dual receipts. I have receipts for my personal because I'm making a donation, but I have receipts for my business to show that these are the donations that have been made. And on my income statement, I'm looking at how much I'm spending. And we're just talking about startup, because we know that whenever you're starting out, you have pennies.
Right. Correct.
So I'm still showing that as money that's going out in order to build up. Is that going to be on this statement as well? Is that going to help me? Is that going to hinder me? Is that going to?
Well, it's from a personal perspective, you will get whatever deductibility of your donation to the nonprofit. That's right. That's a 501c3. Now, within the nonprofit, you take those donations, whether it be cash and stuff, and you use them within the operations. You would see instead of this revenue, you would see it would be like contribution up here as revenue. And then any of the expenses you used with what was donated would show up underneath here. And then it would come through. If it's still like a loss, it would show as a deficit.
Okay.
Instead of net income, it would be a deficit. Now, the problem is that as a personal thing, you're not going to be able to take that deficit and use it with anything else because it's a separate nonprofit entity.
Okay.
If it was a LLC, for profit, then that loss could be used as a deduction of business on your personal tax return if it was a single entity LLC.
Got you.
That's why I said business entities are important in understanding when you set up how you can use it from a personal tax basis or business. You got to look at it from those factors to be able to do that.
I'm just looking at it in regards to how I would present it to, let's say an organization to subcontract, or the government to subcontract, things like that, to say, yes, we, there have been funds, we have done this, we're prepared to proceed. We just need this contract.
Right.
And
yeah,
you would show cut us a check early.
Yeah, you would show any contributions up as revenue and any expenses that you wrote out of your nonprofit business account as expenses underneath to show, profit and a surplus or deficit.
Right.
That's the terminology for nonprofits.
Okay. Thank you.
Mm-hmm. Then the last statement is what we call the cash flow statement. This is important. There's a couple sections in the cash flow statement, and this is dealing with what's running through your business from a cash basis. Remember when I said cash is king? This is important because the income statement is what we call it from accountants GAAP based, generally accepted accounting principles, meaning that it's not just cash, but it's based on the revenues that you have generated. So that's why you have receivables, payables, and things like that, and loans. So the income statement is more inclusive. It's a more better picture of the operation of your business. But at the same time, you can't be running a business if you don't have cash. So what the cash flow statement does is takes that income statement and converts it to how the cash flowed through your business. And you'll see connections with it. But you have cash through operations is one of the sessions. And this is basically the cash from operations is what is basically you start off with the net income or loss from the income statement. And then you convert that to what really came in from a cash basis through operations. So that's the first section. So this tells you how much cash that you're, by running your business, you're generating or not generating. The second section is vesting. It is cash that you receive from the sales of investments and equipment. So if you have investments that you're reinvesting over time that you hold on to, well, that goes underneath that because that has nothing to do with your operations. It goes with excess cash that you're investing. Or if you sell equipment or buildings, that would go under investing, because the person wants to analyze how's your business operation doing versus the other parts of your assets that you're generating or utilizing. And then financing is how much cash you receive from loans. So what this cash flow tells me is your business generating cash? Or are you taking any of your assets to be able to convert that into cash? And are you borrowing to be able to generate cash also for your business? That's kind of what the cash flow statement is telling me. And it gives you that through this analysis. So here's an example of a cash flow statement. From business, I receive, this kind of is the revenue number that's converted, that's cash. And so this is actual cash received from your revenues. This is cash you paid. Remember I said cost of goods sold? This is cash that you paid to get merchandise to be able to sell. And then this is cash that was paid for salaries, generating this cash that came in from your revenue. So that's kind of how you take your income statement and convert it to cash flow for operations. So you might have received, and this is the difficulty. So in your income statement, you might have generated $100,000 surplus profit. However, from a cash basis, you might have only generated $27,000. Because a lot, and what that would tell me is if I saw that income statement showing $100,000 profit and cash flow from operations showing $27,000, that lets me know that you have almost $80,000 sitting up in receivables. And that's how the balance sheet works with the income statement and the cash flow. And so I, as an investor or loan officer, I'm going to say, is your receivables good? Because you got a lot of money sitting on receivable that hasn't come in yet in cash. And I know when I was, would go out for loans when I was running companies and things like that, if you had a high large of receivables, they would want, then the lender's going to ask, okay, I want to see your aging, your accounts receivable, who owes you. I want to see a pattern of them paying to make sure that that's a good receivable, things like that. So your cash flow from operations takes your income statement and produces it based off of cash. Your cash flow from investing takes the cash that you receive from the sale of your investments and equipment, and then that shows you how you receive cash into your business from that. So here, if you sold property, equipment, okay, you get this. But then if you take that cash you got and you bought new equipment, then that cash is going out. So in this example, you have negative cash flow. So basically, you sold some equipment that you needed in your operations to operate your business. You sold some equipment, but then you took the proceeds of equipment and reinvested that into more expensive equipment. That's what this tells me. Now, that could be good because it could be it could be equipment. It could be equipment that is producing more capacity for you. So this is not just always negative, but an analyst will see that, and you got to be able to explain that and say, yes, I sold this equipment, but I reinvested it into my operations. And so if you're something you make clothes, you could have said, I took cash, sold my old sewing machines, and I have more digital machines now that can produce quicker, and I can double my money. That's a good thing. So don't look at negative things as bad. You just have to be able to explain and be on top of it. The last part of the cash flow is financing. That is borrowing money. So here we are. So it's a good thing and bad thing. It all depends on how you're able to do it from your operations. So cash paid for loan repayment. So when you have a loan out, the amount of money that you pay for your loan shows up on your cash flow. That's a good thing. If I'm a lender and I can see that you're paying your loans, I was like, wow, okay. That's a good thing. The other part of it could be then is, if you have money out there that is owed to you that's not coming in, that could be a bad thing. So when you look at your cash flow statement, you go through your operation, your investments and financing, which are borrowings, you get down to a bottom line, net increase in cash. So ultimately, when you say cash is king, you want positive earnings, you want to make sure you got positive cash flow. Because if you don't have positive cash flow, you're not going to be able to do much. And if you don't have positive cash flow, that means you're going to have a capital investment. That means you're going to have to take either personal money or get a loan to be able to put into your business. And then that's why you need to know your projections to say, how long do I need to do this in order to continue to operate my business before it becomes positive? That's the purpose of doing cash flow projections, your income statement, your budget, is to make sure based upon the market conditions and your business operations, you're able to handle the ups and flows of clients, customers, products, expenses. You got to be prepared. Look what's happening now with expenses. Inflation's happening now. Because we had the pandemic, inflation is the price of products over the prior year. So, and the problem is that if inflation, if your product is going up in cost, and it's costing you more, but it's not adding more value, it's inflation. That means the very things we talked about, the labor, operating costs, all those things that are producing that is going up. So they're going to increase the price of that to you. That's going to cost you more for that same product. So that's inflation. There's a lot of inflationary things, just goods and services. Health insurance inflates by about 12 to 15% each year. So your premiums, now if you work for an employer, you might not see it. You might complain about it on the co-payment side. Oh, my premium, what coming out of my check is going up. But I guarantee you, if there's a health insurance premium, the cost of that health insurance overall is going up by at least 10 to 15% each year. And so you have to understand that too, as an entrepreneur or an employer, that you have to budget for that. So when you're setting your prices for the next year or services for next year, you got to budget and project out what all these costs are going to be so that you can price it right. If not, you're not going to have enough cash, or you're going to show a loss on your income statement. I don't have the time, but I will go ahead and I'll upload the file into the chat. I went ahead and just downloaded the YWCA because I know some of you deal with nonprofits. So I downloaded a nonprofit financial statement. I used the YWCA, which is out there right on their website, but this gives you an idea of a balance sheet. Here's the balance sheet. And look at what we said: cash, investments, equipment, and receivables. That's assets. Liabilities, accounts payable. And then you have leases, debt. So these are all the liabilities. And here's the net asset for a nonprofit, which is your net worth, fund balance. They have a very healthy fund balance, $69 million. This is a nonprofit. This is what I'm saying. This nonprofit doesn't mean you lose money. It means structurally, an individual doesn't own that 69 million. It's the community. And you have a board of directors that represents that. That's why when you set up business, you make sure you understand, you can't really go and benefit directly personally from a nonprofit unless you draw it down through salaries. So this is the balance sheet of a nonprofit. Here's the income statement of a nonprofit. And this is the distinction too with nonprofit. You got donor restrict without and with. This is something new that has hit the nonprofit, where only the donor can restrict a contribution. So a lot of times, when back in the day, when money came in from grants and things like that, the organization said, okay, we're going to use it for this, and we're going to use it for that. Well, the way that the rules have changed now, only a donor can say, hey, you have to use it for this. So, so that's important. So what happens in your marketing and solicitation, then you have to specify, to a donor, we're asking you to be able to fund this particular thing. And if they sign off and comply with that, then it becomes a donor restricted. If not, it's unrestricted. And when it's an unrestricted, it can be used for anything within your operations. So they made us break out, accounts had to break out without donor restriction, which is basically old unrestricted, and then with donor restrictions, with donors restriction, which is only the donors can restrict. But you see, here's contributions. Nonprofits can have, they have investment income because they invest excess cash into investments. Donated services. This is another benefit to nonprofits. You don't just have to receive cash, but suppose someone has a skill that you can't afford to pay for. You can have those donated services, like a lawyer, accountant, you can donate and record the value that you normally would pay for. You can record that as a donated service. And then you would also include it as a donated service expense. So it's an offset. So it doesn't increase your income or loss from your profit or surplus or deficit from your nonprofit, but it's a way of showing, to other people I have other people investing into my operations by donating their services. The benefit of that is to the person that donates, they can kind of use that as a write-off then. That's where the benefit comes from. Then when you go down to the expenses, basically under nonprofits, you have to break your expenses into what they call functional. So basically you have program expenses, and these would list all your individual programs and their expenses. Then you have supporting services, which is your management in general and your fundraising that are broken out. And the reason why this is broken out in nonprofit is that because remember, who owns the nonprofits? The people. And so you have to produce information out to the people to say what's been going on with your nonprofit. And they can calculate what percentage of expenses are going to management general and fundraising. That's an important thing. A lot of people want to say, I want no more than 90 cents on the dollar, and 90 cents on the dollar should be going to programs. That means 90% of the money that's being donated into a nonprofit should go to program costs. So they're saying that this amount right here, the $7.7 million of total expenses should be about 90%. If your mentality is 90%. And then 10% should be for fundraising and management in general. That's why you have to break this out. These information is broken out also in the tax return of the 990. This is where I come into an issue when I used to run nonprofits. The mentality though is nonprofits should be working for bare bones. So I'm giving my hard dollar money. They shouldn't be spending more than 10% on management general, because I don't want those execs and managers getting all that money that I've been donating for. The problem with that mentality is most people don't realize nonprofits are much more complex than for-profits. People don't get that. But for-profits have the ability to increase their revenue, their prices based upon what they want for the profit margin. Nonprofits typically are given set amounts by grants. Government agencies typically only fund about 80% of the cost of running particular programs. And so nonprofits then have to raise the other difference. So nonprofits are already starting 20% in the hole when they run a program or service. So, and then what's getting more complex because of it's getting very competitive for grants and contributions. Nonprofits have to be like this size in order to compete. You people are like, oh my, why are there 60 million? Because in order to compete for federal grants, state grants, local grants, even for some private foundation grants, you have to have outcomes, a logic model. That means you have to have a researcher that's going to be able to analyze your program to say they were effective with the dollars and this is why. There's a lot of costs, hidden costs that nonprofits have to be able to use in order to produce services for the public. And then the mentality of the public and taxpayer generally is, I'm working hard for my money, so you need to be working just as hard, so don't be abusing it. Yes, we don't want to abuse taxpayers' dollars. However, we need to also understand it takes more than just paying people at 80% of what they're worth to be able to make up for what you want to do to services. Yes, Roberta.
And that's another thing for anybody in here who's doing nonprofit. I did find a group at UNCG, University of North Carolina at Greensboro, that was just for elderly issues. I found me a professor who's interested, so they're feeding interns, people who want to do that research to put on their resume, students who want to look for grants to practice how to write a grant, and that's all they want to do. So I'm throwing that out there for anybody who, you know, doesn't have that information at this point, where you can get some free help also, which is a donated service. Once again,
that's a good point. Like I said, doing internship or college students that need to get credits and all that is a good way of getting some free or low cost labor, you know, even for-profit. That's the one thing that's where I'm looking at to do for contractors, is that get an MBA student or a bachelor level financial analyst student that needs to get workforce credits or things like that. I can be able to utilize them and train them on certain things while they're getting work experience. At the same time, I'm able to get some of the projects done. So that's another valuable way of getting, looking at your expenses and saying, how can I lower my expenses to be able to increase my revenue? The other,
and also to have that tie with the university for nonprofits, to have that tie with a university, because they're going to know about requests for proposals that are coming out. They're also good people to have on your board to bring all that information to you, to tell you where the trends and turns are going within education and the field. These are things that you need, because while we're starting out at this particular level, education and technology are teaching them something different that we may not have access to because we haven't been in the classroom.
very good points. These are nuggets. This is why I like our group, so that we can share this, so that we can learn from each other. Chanel, the one thing that came to my mind that you could benefit you too, especially in the service industry, a lot of people in the service industry, and then like you're talking about fitness, it could be hair salons, you name it, service industry. A lot of folks in the service industry go into bartering, meaning that, okay, you can, say, I can give you, so many levels of training, sessions of training, if I can get my hair done by this, or you provide daycare services for something, or that's a very common thing in the service industry, is bartering. That way you're
I actually have been doing that. So the person, she's the woman who helped me with my book. She's getting fitness services from me, but my book is kind of ongoing, because initially it was supposed to be one big book, but it ended up being too big. So I had to break it down into 4s. So after my initial payment was completed, but she realized she still, we both realized she still needed to work with me or whatever. And she also wanted to lose some pounds. So now moving forward, you know what I mean? That's what our agreement is. And then I also has a woman who reached out to me who I wanted to do a backdrop for me for people to take their pictures. She was also interested in my fitness services. So that's what I've been kind of doing as of late.
Good. And that's what we don't want to take your skills and use that as, that's a resource. That's leveraging too, to be able to, like, for instance, I don't particularly like to do tax returns and things like that. However, and that's not, I can do those. I do those maybe sparingly, because my big business is analyzing, providing coaching and things like that. However, if I did do tax returns, I could sit there and maybe barter with someone that, that might need that for their particular business and service, and I can get a product or something from that. So keep that in mind. For-profits can barter just like nonprofits can have donated services also. And then here's the cash flow statement from the YWCA. Look at, as you can tell, they generated almost $8 million of cash during 2020. And you can tell, here's the operation. So you begin with the profit and loss for the year, and then you do this is the changes in operations. This is the investment activity. So here we go. So they had investments that matured of 25 million, and they took that 25 million and reinvested 19 million back into other investments, which is what generates their interest investment income in the operation. That's a good strategy for a nonprofit with excess cash. And then they purchased some other equipment. And then here's the borrowings though. They borrowed $1.7 million on their line of credit, and they have a loan out. So when you look at all these different things, the generation of cash, they generate $8 million of cash. So they're in a strong cash balance. And just to sum up too, here's some resources, financial statement resources to help you. You can do financial statements. There's templates in Excel. Then, a lot of small business folks, and you see the push is using QuickBooks. I use QuickBooks for my business. There's different pricing structure for QuickBooks, and I have it on the next slide. But QuickBooks, you can do your income statement, cash flow, all those statements. You can even put your budget in. You can even do payroll through it, depending upon what service you want to subscribe to. So a lot of things. So QuickBooks is packaging themselves up to be the small business accounting package. you know, and so that they have pre-printed charts of accounts and layouts. If you want to set up your business, if you want to subscribe for additional costs, you can have a contractor and an accountant work with QuickBooks to be able to set up your books and things like that. So that's a good resource. And I only say that so that if you're looking at building and expanding, that you recognize what that expense is so you can build for that in it. And this is contrasting to actually getting employment or individuals. Just so that you have an idea of a financial analyst or an accountant, you can check out the cost, so that you're aware, you're on average, you're looking at $60,000 a year for a financial analyst. And you're looking at, depending upon what level of accountant, $50,000 to $100,000 for an accountant. And that comes from salary.com, which you can get update positions across the board. Here's just a pricing thing for QuickBooks too. Depending upon what level that you want to go, you can get pricing from $12, $25, $40, or $90 per month on a subscription basis. I just remind you all about a good book that I had used to look at business entities and starting your business and startups. Is good to, this is by Greg Shields. And once again, our last session is scheduled for next month. The one topic I was going to go over was getting hiring process right, because I was requested early on the previous sessions. But since this is going to be the last session, I really want to have it open up, that if you all have questions, I want to have it open up so that we can just discuss anything that we've learned over this year, any question you have for your business, be able to have that time available to really just do direct questioning. So, I might prepare something for getting the hiring process, but I really want to have it as an open session for those, that are trying to grow their business and go through that. So that's going to be December 11th. Once again, from 10 to 11. I'm going to upload this video and the session once again to the YouTube. So once again, if you want to reach out to me and before December 11th, and you have a question that might require me to look something up to research, send it to me through our Facebook or through our networking group, Loving Ourselves Business. You can go through there and post it there. My Visions 2020 LLC on Facebook. You can send it through Instagram, Twitter, and then the videos get loaded up into the Facebook and YouTube, so that you can go ahead and look at them again, or you can even send it to someone else or share it, with others that might be interested. I ask once again that, subscribe to my Visions page on Facebook and Instagram, and also to YouTube, because as that grows, that gets me another way of source of having content out there that I can really be able to market and be able to start getting ad revenue off of that, once I meet that threshold. So please subscribe if you're out there on YouTube.
You're going to download those documents on the Loving Myself First?
I'll put that out there, but in fact, before I shut down, let me upload the document here to everyone here so that you at least will have that. Okay, let's see. Oh, what's going to? Oh my God, here we go. And we see understanding financials. And here's the full YMCA PDF of there you go. So
thank you.
That's out there for everybody. Okay. So if any other questions that anyone has? Well, if not, I thank you again